Is the US government crashing the stock market to save the bond market? It's no secret that the US has a very bad national debt problem. The US is over $36 trillion in national debt. And in 2025, a good amount of that debt is going to need to be refinanced. The problem is, who is going to buy that debt? With the way assets have been ripping over the past couple of years, stocks, Bitcoin, even gold, nobody really wants treasury bonds. Recently, we've seen the stock market crashing, we've seen Bitcoin crashing and other assets crashing, and it's making me thinking that maybe the government is doing this on purpose to push people into the treasury bond market, and they're trying to push yields lower so that they can refinance this debt that they need to refinance. So that is what we are going to get into today, this strategy that the US government may be doing right now. Before we do get into the video, please make sure to like the video and also subscribe to the YouTube. I'm also going to put a QR code down below for a Bitcoin tip. If you want to support the channel, feel free to leave me a little tip. Now let's get into it. According to the Kobayashi letter, one of my favorite accounts on X, $9.2 trillion worth of the federal debt is set to mature in 2025, and that debt will need to be refinanced. And also, according to the Kobayashi letter, 70% of that 9.2 trillion, so $6.44 trillion worth of that debt is set to mature before July. So the US government is in a predicament. They have to refinance all this debt. But when we look at treasury yields, they're pretty high. For most treasuries, the yield is between 4% and 5%. Let's go ahead and take a look at a little chart here, which shows the 10-year treasury note, and it shows it over the past 10 years or so. As you can see, around 2020, we saw treasury yields shooting down when we had the COVID crash. Over the past 5 years, treasury yields have been heading higher, and that's because prices have been heading higher. We've seen asset prices shoot up over the past 5 years. We've seen the prices for things like groceries heading up higher. And with prices heading up, people are going to demand a higher interest rate when they lend the government money. And with the treasury yields around 4 to 5% right now, that's a little bit too high for the government, who is looking to refinance around $9.2 trillion worth of debt this year, right? They want to see these yields head lower. But people have seen how much these assets have performed over the past 5 years. We look at the stock market. Let's actually go ahead and take a look at a chart here. The stock market is up almost 100% over the past 5 years. And then if you look at Bitcoin, Bitcoin is up even more. Bitcoin is up almost 1,000% over the past 5 years. You can even look at something like gold. Gold is up huge. And people see the way these assets are performing, and they're thinking, why would I buy a treasury bond and get paid this low yield by the government when I can just put my money into the S&P 500 and outperform treasury bonds? So when we look at that chart of the 10-year treasury note, when did treasury yields go down? They went down in 2020 when all these assets were crashing. And that's what makes me think that the government may need assets to crash in order to push treasury yields down and in order to push people into the treasuries market to refinance this debt. The problem with these long-term treasuries, these 20-year, 30-year treasury bonds, is that people are starting to wake up to the fact that the US is not in a great fiscal situation. We're over $36 trillion in national debt. We're nearing around $2 trillion deficits, and people are seeing the consequences of this in the economy. They're realizing that it is unaffordable for them to buy a house. They're seeing homeless people showing up in their community. They're learning, right? We now have the internet. We're in the internet era, and people are realizing that this is not sustainable. They're reading about when this has happened in history, when countries have become over indebted. What happens? We see the currency collapse, and people don't want to bet on the US over the next 20 to 30 years. So in order for the US government to really push these long-term treasury yields down. They have to make people think that there aren't better options, that they need to buy into long-term US treasuries, because if they buy into other assets, it's not going to be as great. And that is going to be tough to do. And it makes me think that the US government probably isn't going to be able to push these long-term treasury yields down too much. For short-term treasuries, I could see people willing to take on the risk because you don't have that long duration risk. I think people would rather bet on the dollar over the next couple of years than the next 30 years. But we will have to see how low these treasury yields can really get, because I think people understand that most other assets are going to outperform treasuries. Now let's get into the strategy of how the US government is crashing the stock market and other assets. The main thing they've done is they've implemented significant tariffs on the three largest trading partners of the United States: Canada, Mexico, and China. And with these heavy tariffs on these countries, it is putting pressure on the stock market. It is putting pressure on businesses, and it is leading to higher expenses. Most businesses here in the United States rely on importing. We import a lot from other countries, and when there is a 25% tariff or a 50% tariff on these large trading partners of the US, it leads to higher expenses for these companies, for these businesses. And with that, they see a tighter profit margin. It means that a lot of these businesses have to look to hike their prices, or they have to cut their employees, they have to cut divisions or side projects. You also have to think, can a lot of these businesses really handle these tariffs? Can they handle these increased expenses? And could we see some businesses go under over the next 6 months, the next year, as we go through this transition period? Now, the Trump administration is implementing these tariffs for two reasons. One is for this, right? They want to crash the markets a bit so that they can push people into the treasuries market, push yields lower, and refinance the debt that they need to refinance. And the other reason is that they want to bring production back to the United States. We've become very reliant upon other countries, and the Trump administration thinks that if we implement these heavy tariffs, it could bring production back to the US. We could see our GDP rise, and with that, we can have a shot of maybe working away at this deficit issue, at this national debt issue, and we can become more self-sufficient from it. The second thing that this administration has done is they have created this Department of Government Efficiency, or DOGE. And what this Department of Government Efficiency is doing is they are going through all the government budget items and they're cutting government spending. And this is leading to a lot of layoffs, and that is going to have a negative impact on the economy in the short term. If thousands and thousands of these government employees are getting laid off, that means that they're not going to be spending as much money in the economy, and that is going to contribute to weaker economic demand. If you've looked at the jobs numbers over the past couple of years, you know that a lot of these jobs that have been added and have been propping up these jobs numbers are these government jobs. So I think we are going to see a big change there with the jobs numbers coming out over the next couple of months here. And when these jobs numbers come out and they don't look as great, I don't think that the stock market is going to like that. I don't think that the other markets are going to like that. So those are really the two things that the government is doing right now to push markets lower in the short term. Now, there's another part of this strategy that we need to talk about. We know that Trump is a proponent of lower interest rates. We know that Trump has gotten kind of mad at Jerome Powell in the past for keeping rates high. And we know that Trump believes that with lower rates, it's going to lead to more economic growth. It's going to lead to more opportunities. And he thinks that it's going to allow the economy to thrive more. But the problem is, if the Fed cuts rates right now, we just see assets rip, right? There's just too much steam in the market. We saw this in September after the Fed started to cut rates. If we look at this visual here, you could see after that rate cut, in September, we saw Treasury yields heading higher. So it looks like the Fed has kind of lost control of interest rates. And if they cut rates right now, interest rates are just going to go higher. It's going to lead to more inflation. And as inflation heads up higher, lenders are going to require a higher interest rate because they want to beat inflation. What needs to happen for the Fed to cut rates? There needs to be a market crash, a market reset. And that is why the Trump administration is trying to do this in the short term. If they can engineer a light recession and we see asset prices crashing down, then people are going to shift into the Treasuries market and it will lead to interest rates dropping because lenders will be willing to accept, a lower interest payment because they can't really beat that return by investing in other assets because those assets will be crashing. Now, engineering a light recession is going to be a difficult thing to do. And I think that after the US government refinances a good portion of this debt that they need to refinance this year, they'll probably come in and pump the markets. They'll try to come in with QE, where the Fed buys treasuries out of the market and pushes liquidity into the market. We could see the government come in and provide fiscal stimulus. We will probably, like I said, see the Fed lower the federal funds rate if we get a market crash. But it's definitely risky business. And I really don't know how much the markets can crash before we run into some serious problems. We live in this economy that is based around debt. And as we see prices heading lower, as we see the stock market crashing, assets heading down, this debt will start to collapse. And that is going to lead to big problems for the US government that I don't think they want to deal with. We can think about an example like this. Let's say a large company sees a big sell-off in their stock. They start running out of liquidity and they have trouble paying off their debts. And let's say they default on a loan, and that is a big loan, and that causes their bank to run into problems. Their bank loses money on that loan that's defaulted upon, and then the bank fails. And then other businesses who keep their money at that bank lose all of their money. And what happens is the government has to come in and bail out some of these institutions. And this sort of domino-like effect can get way more intense than that, right? If we see a couple of big players fall, it can lead to everything falling apart. And we saw this back in 2008. Things started to fall apart and the government had to come in and save the economy. And when we think about the state of the economy now, it is much more fragile. And if these dominoes start falling, it is going to be difficult for the government to pick them up. So let's go ahead and take a look at another visual here. This shows all the bank credit out there. It looks like this chart goes from around 1970 to present day. And as you can see, bank credit has been rising. There is a lot of debt out there. And if we see prices contracting, if we see stocks crashing, it is going to lead to a lot of this debt getting defaulted upon, and that is going to be a difficult situation to clean up. When we look at the US fiscal situation, which we've been talking about, if we do have this big economic contraction, what is that going to do to the US GDP? It is going to bring it down a lot. And the US needs to be making more money, not less, right? If we're having less GDP, that means less tax receipts, and that means worse deficit problems. So this crashing the market strategy may be helpful in the short term for refinancing this debt, but ultimately it's going to be bad in the long term, right? You're crushing the economy a little bit, which is tough to do, which is going to lead to wider deficits. And we know that these deficits are driving inflation. If you're getting wider deficits, you're going to see the interest on debt expense continue to grow. You're going to see the national debt continue to grow, and the situation will just continue to get worse. So I don't really like this strategy because in the long term, you're just screwing yourself over more. Now, the problem is the US may not really have a choice, right? If they refinance all this debt at these current yields, that's also going to lead to a lot more national debt. So really, this is kind of an unfixable situation. But when you think about crashing the economy, that's never really a great strategy, right? The US really needs to, if the US has any chance of getting out of this fiscal situation, they need to be producing more, they need a higher GDP, and they need to be spending less. So crushing your GDP is never a great strategy, to be honest. And when you look at government spending, right now, this Trump administration is trying to cut back on spending. But if you crash the economy and you get into this bad recession, think about how much money the government is going to need to spend to get out of this situation. That is just going to contribute more to the national debt, and it's going to kind of fight against the cause that they're trying to fight right now. Last thing I want to talk about is the reputation risk of this strategy. We know that Trump is kind of known as this pro-stock market figure. When he was running for president, it was believed that he would be the better candidate for the stock market. And now he's in office and we're starting to see the stock market crash. Now, I believe that he would rather see the stock market crash at the beginning of his term than the end of his term. People kind of think about, what have you done for me lately? And if he can kind of maneuver this situation to refinance the debt and he can get the markets back up in 6 months to a year from now, then I'm sure people will kind of forget about the situation. You also think about the fact that his administration will probably find a way to blame this on the Biden administration since, we're still in the first couple of months of his term. So I think that is part of the strategy. Do the dirty work now at the beginning of the term so that you can end the term on a solid note. They need to be careful that they don't damage the stock market too much and that we don't get into a crash that lasts a long time, right? If you're not careful and we see a lot of this debt collapse, then who knows how long we could watch markets head down. I find it hard to believe that this administration is really going to let the stock market crash for too long or too much because they know about that risk. And we also know that the dollar is just going to continue to inflate away with these deficits, with inflation. As the dollar heads down, I find it hard to believe that the stock market is going to head too much lower in dollar terms. I think that generally you don't want to be in the dollar over the next 5 to 10 years. And getting into assets, really hard assets like Bitcoin, is going to be your best bet to hedge against that dollar debasement. So we will have to see what happens. I'm staying put in Bitcoin as I always do. I don't mind if we head a little lower in the short term because long term, I know we're heading a lot higher as the dollar continues to depreciate away. That is going to wrap it up for this one. If you didn't like and subscribe, please make sure to do that now. Thanks for watching. I'll be back soon.